Welcome back. The Federal Reserve starting the year with a tougher policy path ahead, including balancing inflation, a cooling labor market, and a looming leadership change after 3 consecutive rate cuts last year. Federal Reserve officials signaling caution. Minneapolis Fed President Neil Kashkari said rates may now be closer to neutral right now, while Philadelphia Federal Reserve President Anna Paulson is warning that additional cuts, quote, could take time. Markets echoing that restraint. Futures traders are now pricing in an 84% chance that the central bank holds rates steady at the next meeting, which is January 28th. Joining me now is Federal Reserve Governor Stephen Miran. Stephen, good to see you. Thank you so much for being here. Can you give us a sense of your expectations of Fed policy evolving through 2026?
Happy New Year, and thanks for having me. Look, I can only speak for myself. I can't speak for the other members of the committee, but I expect the economic data to continue coming in line with additional cutting being the appropriate response. If you look at the inflation data, almost all of the excess inflation over the Federal Reserve's 2% target is due to statistical quirks of how we measure inflation. It relates to a housing inflation crisis that we had 3-4 years ago, not to how the housing market is now. If you look at the housing market today, if you look at the rent data today, market rents have been growing at a 1% rate for a couple of years now, right? Like, there is no material inflation in housing, and yet that's driving so much of the measured excess inflation over our target just because of some quirks of how the data are measured. They're very backward looking.
Well, we just spoke with Larry McDonald. He's the founder of the Bear Traps Report, and he zeroed in on a specific issue that's bothering him, and that is the banks. He believes that the banks are going to be holding the bag for loans gone bad for data centers. We're expecting all this data center build out with this AI enthusiasm. Somebody's got to pay for it. The banks are lending out money to do so, and Larry's expecting them to be facing default. Your reaction?
So, delving into the economics of data centers, the financial loans that have supported them isn't really sort of our core expertise here. We sort of take what financial markets are doing as an input into our process, and we're thinking about what the appropriate setting of monetary policy is and where's inflation going, where's the labor market going. But excuse me. But we don't try and, we don't try and think potentially, 3, 4, 5 steps ahead about what financial markets might look like, 6 months or a year or 3 years from now. What Larry's saying very well might happen, but it also very well might not. And so, I'd rather respond to something like that if it were to occur rather than to try to set policy ahead of time to anticipate it.
Given your expectations for the macro story and inflation, Stephen, would you be poised to endorse cutting interest rates this year by 100 basis points?
I think we've got to cut more than 100 basis points this year.
Okay.
I mean, look, measured underlying inflation, once you adjust it for quirks like the housing thing I was describing before, once you adjust it for quirks like the portfolio management services contributing 25 basis points to core PCE inflation, despite continual cuts in fees that are actually charged to investors. Once you adjust it for those things, underlying inflation is running within noise of our target. I gave a speech about this about a month ago at Columbia University. And so underlying inflation is already running reasonably close to our target. The unemployment rate has been very gradually and slowly creeping up. I think it's very difficult to argue that policy is about neutral. I think policy is clearly restrictive in holding the economy back. And with underlying inflation basically within noise of our target, I think that, well over 100 basis points of cuts are going to be justified this year.
So Governor, that takes me to my next question, because I'm reading a report from Jarrett Seaberg over at TD Securities, and he writes this: our view continues to be that Kevin Warsh is the likely pick for the next chairman of the Federal Reserve, although much of Washington expects Kevin Hassett to get the nod. We believe the probability has risen that neither Hassett nor Warsh will be the pick, because we do not see either of them committing to cutting rates by 100 basis points or more this year. Lower rates matter to President Trump, not just because they could boost the economy, but also because they will bring down mortgage rates in advance of the election. This could help with housing affordability, and it is why we believe one has to seriously consider Stephen Miran, who is on leave as Trump's Council of Economic Advisors chair to serve as the Fed governor. Miran is the only one to argue that the Fed should cut rates at least another 100 basis points. Have you spoken with President Trump about the potential chairman's job?
I have not. I have not. It's not something I've put myself forward for. I think the president has a slate of extremely qualified candidates in front of him. I think all of the names that have been floated, that have been on his list, that he's been conducting interviews with, I think all of those names are extremely credible. They're all extremely talented, and I think they'd all be extremely capable policymakers, and we'd be very lucky to have any of them.
When are you expecting the announcement?
Well, I think it didn't. You probably are as aware of this as I am, but I think the president signaled that he would be making an announcement, that he expected to make an announcement sometime in the new year. Well, we're in the new year, so I don't know when he will make it, but I imagine that when he has made a decision, he'll let us know.
So all eyes, of course, are on the other major decision that we're waiting for, and that's the Supreme Court decision on President Trump's tariff authority. This ruling could shape how much leverage the White House has on trade, prices, growth going forward, because it could sort of end or land on whether or not the U.S. has to pay back money to importers. President Trump is talking about a strong economy, pushing this affordability message, pointing to faster than expected growth in tariff revenue. The president's also promising the largest tax refunds ever this year ahead of the midterms. Got regulatory rollbacks, a lot to talk about in a good story about the macro story. Do you expect the Supreme Court decision to throw a wrench into all of that?
Well, look, I think you mentioned a couple things that are important for thinking about the outlook. I think that the tax refunds that are coming out, and some of which are related to what happened with the One Big Beautiful Bill, I do think that they're gonna support growth as we go forward. I think some of the other provisions, like the full expensing on equipment and various investments, are also going to be a tailwind to growth as we turn the corner into the new year going forward. With respect to tariffs, that's not something that we at the Federal Reserve really deal with. I have spoken about how tariff revenue can play a very important role in affecting the fiscal deficit, and through that, the national savings versus national borrowing balances, which then matter for interest rates, because if we are borrowing less and we're saving more because we're getting all this tariff revenue basically from countries that export to us, that revenue comes in and it lowers our interest rates, both sort of further out the yield curve, but also it lowers what we at the Fed call the neutral interest rate, the interest rate that's neither stimulative nor restrictive for the economy. So I do think that the tariff revenue plays an important role for things that we have to think about for monetary policy. But look, I'm not a lawyer. I'm not involved in those cases. It's not something that we at the Fed handle in terms of thinking about what's actually going to happen with the legal outcome.
Stephen, the Federal Reserve has been gathering feedback on a plan for a limited master account. Can you tell us about that? I think these payment accounts would be an alternative to master accounts for crypto and fintechs, and analysts say that this would be a positive for crypto entities and fintechs, as they'll be able to settle their own accounts directly rather than having to partner with a bank. What is your sense of these limited master accounts?
Yeah, absolutely. So I'm really excited about this. So what the limited accounts do is they give innovative payment systems like crypto a means of having access to a range of Federal Reserve services. Now they're limited because they don't come with all of the access that a full master account would give. There are some limits on account balances. There are some limits in terms of when payments can occur. But beyond some modest limitations like that, they do give access to a range of payment services offered by the Fed, which will then facilitate innovation. Because I think, look, any economist will tell you that innovation is the most important driver of long-run growth and long-run prosperity and long-run American well-being. And I think there has been and remains a lot of exciting innovation occurring in the payment space, in the crypto space, and I think that it's really important that the Federal Reserve move forward with implementing these limited master accounts so that innovation can continue to flourish.
Well, we'll see if the banks try to derail the proposal, because of course it's going to be a big positive for things like stablecoin issuers. Real quick before you go, Stephen, Goldman Sachs is expecting the economy to accelerate in 26, GDP of around 2.6%. But we spoke with Louis Navellier, who is talking about 5% growth at some point. Do you see 5% growth at some point this year?
I don't see growth that high. Look, I'm optimistic on economic growth, as I said a moment ago. I'm delighted that Goldman has come closer to my views on growth. I'm also very close to Goldman's views on where inflation is heading. If you look at my inflation forecast and theirs, I don't think that there's that much daylight in the overall numbers. I have a lot of agreement with them on some issues, and so I do think that economic growth is going to pick up and be decent this year. I do think it's important that we get monetary policy into a position to actually accommodate that economic growth. If monetary policy remains too tight, as I believe it is, then we might nip that growth in the bud before it materializes, which would be very unfortunate, considering that underlying inflation is running pretty close to our target, and we are in a position to be able to allow the economy to grow.
So if we do see this kind of an economic boom, and we see a GDP, even if it's just a quarter of 5%, like Louis Navellier is talking about, or even 4% or 3%, like you're talking about, do you worry that cutting interest rates too aggressively will heat things up a bit too much?
Well, of course, if you cut interest rates too aggressively, it will do so. But I don't think that the interest rate interest rate prescription that I've written down is too aggressive. Look, it all comes down to supply and demand. And if supply is being held down while you stimulate demand through something like interest rate cuts, I think that we've seen that many times through the course of American history. However, if the supply side is expanding because of technological innovations, because of tax policy, because of regulations, then you're in a position in which demand can expand, and because supply is expanding also, you don't get inflation. And so I think it's really important that we do a really good job analyzing the supply side, and that's what I've attempted to do in my time while I've been here at the Federal Reserve. And so this is part of the reason why I don't really expect a lot of inflation moving forward.
Well, it's important to look at the supply side, 100%. Stephen, it's great to talk with you this morning. Please come back soon. Thank you, sir.
Thanks for having me.
All right, Stephen Miran.